If you want to buy a home and you don't have a down payment, you need a down payment assistance program. And on top of all that, you don't have the best credit. I'm here with Dan Friel, Barrett Financial. My name is Philip Tyrone with Evergreen Financial Counseling. Dan, let's talk about this because down payment assistance program, it's not known. People think either you have a down payment or you don't. I'm either going to buy a home with the down payment or I'm not going to buy a home. That's not the case.
No, it really isn't. So there's options out there to help you as the home buyer, right? So the way I like to present it to the clients that I work with is a mortgage is if you imagine a triangle, there's three different points.
Mhm.
And a mortgage is made up of credit, income, and assets. And perfect world, you want all three to match up. That puts you in a nice box for your mortgage. That's what most people think. However, if you don't have a down payment, you have two out of those 3 points,
Right.
you can still make it happen, right? And that's where the down payment assistance program comes into play.
So how do you, so let's just pretend you're buying a $400,000 home. 3% down for a first-time home buyer is going to be like $12,000 down.
Mhm.
5% down is going to be $20,000. You're saying you could take that 12 to 20,000 and shrink that dramatically depending on the lender and depending on the credit score. Is that right?
100%.
And how low can you get that down payment? I mean, can you get that $20,000 down payment to 1,000?
Yeah, we had one close this week where it was under $1,000 cash to close on a brand new home in here in Arizona.
Okay, so how did that person, like, let's talk about that client. So what
Yeah.
was their down payment going to be?
So their down payment was going to be a 3.5% down payment. It was going to be an FHA loan.
Okay.
Credit score was between a 620 and 630.
And what was the purchase price?
Purchase price was 400,000.
So $400,000 and they were going to pay 3.5%. They were going to put 14,000 down.
Correct.
And they had a 620 to 630 credit score. And they came to you and said, Dan, we don't have the money for this down payment. And you said, well, let's apply for the down payment assistance program.
Yep.
And you dropped it from 14,000 to under 1,000.
Correct. Because the down payment assistance programs, not only do they cover your 3.5% down, but some programs can do even more to cover title fees, taxes, homeowners insurance, things like
Um,
that. It can cover more.
Unbelievable. So, but like why did the bank give this person 13,000 to make this loan? Like they don't have the best credit score. Like a 620 credit score is not the best credit score.
Hmm.
They were making money. Obviously, they had a good stable job.
Yep.
Okay. And what else? Is there anything else? Like, yeah.
It's pretty simple these days. It's kind of hard to believe. But yeah, if you have good income,
Mhm.
so on our lender side, the debt to income ratio has to be very reasonable, right? But it doesn't have to be crazy. So reasonable income. This client had a normal job. They weren't making buku money or anything. It was very normal average income, right?
Okay.
Credit score, if you're above 620, you have a lot of down payment assistance options. That's kind of the tier you want to be. So very easy to get there, especially with Evergreen's help. I mean, it doesn't take long if you're below 620 to get above
Right.
that 620 point. And then, I mean, we don't need any much or any assets, right? We needed $1,000 to close. What we did on this specific home buyer is we just waited for them to get paid so we could say, hey, we have over $1,000 in our bank account. This is the proof that we have the money to close. And there you go. I mean, we're setting these people up in brand new homes and great payments. I mean,
And the
it's
way
incredible
rental
these days.
prices are, the way these REITs or these real estate investment trusts are buying all these homes, they're raising the rental prices.
Yeah.
So I bet you their interest rate and their payment on their mortgage was going to be lower than their rental would have been.
100%. Yeah. We get complaints all the time of, hey, my rent went up $500 this
Yeah.
year. I
Oh
can't,
yeah.
I can't afford that, or I don't want to pay that. I have to buy a home.
It's cheaper. It's so counterintuitive, but like it's
Yeah.
cheaper to buy a home.
Yeah,
And
it really
and
is.
and a lot of people, and I didn't realize this until you just brought this up earlier, is because like most people don't think they can buy a home because they don't have the down payment. But if they have a normal job, and when we talk
Mhm.
about normal job, let's talk about what that means. It's a W-2 job, right? It's a job where you get a consistent paycheck. Is that's
Yeah,
that's important, right?
correct. But there's self-employed people. We can still help you. I mean,
So if you're self-employed, like a real estate agent or whatever,
Mhm.
if you're self-employed, or you're a plumber or fill in the blank. You need to be in that business for 2 years, right?
2 years is the general rule of thumb. Really, 1 year tax returns
Okay.
is the minimum we can do.
So,
But yeah,
okay.
2 years is generally what I recommend.
So if you have 1 year's of tax returns and show bank statements or whatever, 2 years of tax returns if you're self-employed, and you said early debt to income ratio. A lot of people don't realize what that is. It's the income divided by your debt.
Mhm.
But don't try to figure that out yourself because you're probably going to do it wrong. Is that fair to
Yeah.
say?
Yeah, it's if someone explains it to you, it's very simple, but
Yeah,
there will be things that you miss or extras that you add in that you don't need to, because
that's the
the
key.
federally regulated industry, which is mortgage, they have specific rules, right? And sometimes you'd be surprised on what is not included in the debt to income ratio and then what is mandatory and included.
So if someone's watching this video, Dan, and someone's like, I'm interested in learning more. What,
Mhm.
when should they reach out to you? When do they on this video and at Evergreen, we have a form you can fill out. It's going to basically see if you qualify and to talk to Dan. He's licensed in 49 states. You fill out this form and then you're going to get in touch with Dan, his calendar. When should someone reach out to you?
I always recommend when you get the first inclination of you want to buy a home or you want to refinance anything with a mortgage, call us, because that way we can briefly talk about what your goals are. We can put some options together. There's no fee, there's no impact to your credit to have a
Yeah.
conversation, but it gives you the roadmap of, okay, this is where I could go if I wanted to go that route. And then the ball's in your court. It's up to you, but know where you're going to go. And that's why call us when you first think about it. Otherwise, you might end up someplace else, and that's never fun.
Well, also, if you run your credit score and let's just say you have a 580 and you don't qualify for the down payment assistance program, you can sign up for Evergreen's Credit Rebuilder program, $39 a month. It's
Yeah,
going to boost your credit. And when you get to 620 or 630 or whatever it is, you can cancel it and you can get in this home. So teamwork, that's the whole purpose of why we're doing these videos. We want to educate people in debt that they have a path forward. We want to educate people about their future because your future should be brighter than your past. And that's the way it should be for all of us.
100%.
Dan, thank you for your time.
Thanks, Philip. It's great talking to you.
Talk to you soon. Bye bye.
Bye.